For all verified facts, subscribe to our YouTube channel and click the bell icon to get the latest updates.
Hello and welcome to From the Front Lines. I'm Govindraj Ethiraj. The Sensex continues to go on a trajectory where obviously it has not been before. It hit a record of 44,161 today, while the Nifty hit a lifetime high of 12,934. It ended a little lower, 43,952 for the Sensex and 12,874. More importantly, a couple of things have happened. The brokerage house of Morgan Stanley is now projecting a 50,000 Sensex by the end of next year. But as you know, when these kind of projections happen, usually it tends to happen a little faster. Goldman Sachs has said, another investment banking house has said that it is projecting now a lower contraction in the economy for the next year. So not just are the markets projected higher, but the economic contraction that was earlier expected is now much lower, all of which points to a much more resilient economy. Remember that the Sensex was down 40% from January to March thanks to COVID-19 and has rebounded subsequently in a manner that was obviously not expected by anyone. So to understand now what this new era or world means, where we are looking at a 50,000 Sensex or almost touching it, and is that likely to be a peak, or is it just another base from which it continues to newer highs, or is there something else that we should be either worried about or happy about? To discuss that, I'm joined by Sanjiv Bhasin, Director at IIFL Securities. Sanjiv, thank you very much for joining us. So how are you seeing what you're seeing right now in the stock markets?
Yeah, hi Govind. Firstly, to you, your team and the entire investor community, a very, very happy Diwali. Stay safe.
Thank you, and thank you, and same to you and your colleagues as well.
But the saying safe has been the main criteria. But along with that, we've got, the best icing on the cake. The stock market has been the best indicator of what pessimism and fear was, and now what greed is, in a way. So I think pessimism and obituaries were written across the board by large broking houses, economists, when we hit 7,500. And now the same brand of people are painting the picture like the town is being painted red. So yes, take it with a pinch of salt. But it tells you that if of all asset classes, namely bullion as in gold, silver, fixed income as in FDs, bonds and real estate and equity remains the best spot given that bond yields are hitting multi-year lows, and this wall of liquidity is going to chase higher yielding assets with emerging market stocks being the best. So in the short run, the liquidity is making you feel like you're left out and all falls are being bought. And in the longer run, it means that for the next 2-3 years, the money printing by central bankers is here to stay. So if you had a SIP and you've been doing that, you are being very, very wise, because there is no other asset class which gives returns like equities, right, both on the side of greed and fear. Fear was overplayed at 7,500 and now a large part of the greed at almost 13,000.
Right. But Sanjiv, if you were to go back to January when we had 40,000 plus levels on the Sensex, now between then and now, suppose you had not done anything. You were invested earlier and you continue to be invested now. You have not invested nor have you sold. Would things be much different?
Well, the composition has changed. You know, there was the market breadth in the last, before January was very, very skewed towards few large caps. Now that has changed because with this cost of money following, there is a large part of the mid caps who could go through this crisis and who have emerged as winners. So, mid caps have done extremely well. In fact, if you see today, it's the 12th day running that the mid cap index is outperforming. So I think the breadth and the constitution of stocks has changed. But like you rightly said, if you are an investor who has a longer term horizon and who wants to own equity as an asset class, then you can see no change from January to November, because your stocks are or your index or your SIP has done relatively well.
Right. And SIP is systematic investment plan. And when you say SIP, you mean investing in mutual funds, Sanjiv?
Yes, correct. So just to clarify, a SIP is a systematic investment plan where every month you or week or depending on your horizon, you invest for the longer term. So, the idea behind is that you're not trying to time the market. You will never be able to catch the top and bottom, but you're looking for the next 2, 3, 5 years where equity as an asset class becomes a very, very rich portfolio and it does well and it beats all other asset classes as far as returns. So that SIP has been a very, very good instrument, and it has, seen you from 7.5 to 12,000 and now beyond that.
Right. So now let's look at these two projections. One is of the Sensex and the other is of the economy. And if I look at the Sensex first, a 50,000 Sensex by next year end, which of course might well be hit much earlier. What's your first reaction to that?
Well, take it with a pinch of salt. The same guys were writing the obituaries of the Indian market and calling for targets of 5,500 when we hit 7,500. So it's purely greed and fear. They have a large broking fraternity and investments, and now 50,000 seems all hunky-dory. Don't get caught into that web. There will be sharp corrections. The underlying theme tells us that the economy and the reopening is going to be a costly affair. Government is running very low on finances. So there are a whole host of negatives also to be built in. But it tells you that if you are a longer term player, then these, these moments of despair are actually very, very good times to enlarge your portfolio. So take it with a pinch of salt, Govindraj, that you're not going to hit 50,000 anytime so soon. It will take time, it will take patience, and there will be a lot of opportunities where you will lose sight of the upside and look more on the downside. So all in the game plan of how broking houses work and do. At 7.5, 5.5 was visible, and at 43,000, 50,000 is very much a call.
So one of the things that's changed obviously is the fact that we have a vaccine or two vaccines on the horizon, which we can trust, or at least trust more than some of the other vaccines that have also been launched. And therefore, that means normalcy could return. The second thing seems to be that the Indian economy has been more resilient than people thought, and therefore is bouncing back. And maybe other economies elsewhere in the world are as well. And the third thing seems to be again that the markets which were running ahead of the economy now seem to be also reflecting the fact that the economy is not as bad as it is. Because if in my earlier conversations, the question was about why are the markets doing so well when the economy isn't. Now the economy seems to be looking better, at least in terms of projections, than the market. So how is this all coming together, if it is, Sanjiv?
Yeah, so very good point. And, the good point is that the vaccines are here now. There is a pinch of speculation, because the amount of money going into research and pharma is never been visible. In our lifetimes, we never knew what COVID is. It's the first time I've heard of it and living with it. And secondly, the vaccine, when it comes, Indians by nature are more psychological. They don't care. It was first the lockdown, then the reopening. Now you're back to business. So if you keep your checks and balances, you keep your social distancing, you keep your mask, you're back to business. I've been attending office for 4.5 months, touch wood, without any problem. And if my focus is on, doing my job, then these things are just part. So living with COVID should be the new norm rather than expecting the vaccine to work miracles. There is a lot of cost involved, how fast we can get the efficacy, how fast the distribution. A. B. Yes, the Indian consumption story has been very, very, live and kicking, in the sense that Maruti sold 180,000 cars, Hero Honda selling 8.5 lakh motorcycles, and everyone thought that we were done and dusted. But I think the rural economy has shown us very, very strong pullback. The crops have been good, the distribution has been good, low cost of money, some of the government measures, all that put together has been extremely positive. And like I said, German bond yields are trading at minus 0.6%. The US bond yield is at 0.5. In history, you've never seen that. So this money printing is here to stay. However, like I said, a large part of that is already in the price. Don't chase the new macros, because now there is a huge left out feeling. And fourthly, Govindraj, let me tell you, in these 6 months, there has been a new brand of millennials called the Robinhood investors, who have ignored the mutual funds or the soothsayers. And they have been the ones who are actually laughing their way to the bank, because old diehards have been waiting for numbers and economy all to fall in place. That is never the perfect scenario. Stock markets never give you the perfect scenario, neither on the downside, neither on the upside. So right now, take it with a pinch of salt, but you are really nearing a top, and you could see a sharper than expected correction. At that time, don't lose sight of the mark that you have to be prepared for volatility, which will be the new, instrument for some time to come.
Right. So last question. So therefore, your advice to investors, should one be a Robinhood investor? Should one not be, or should one now stay away?
So it's all about participation. You know, it's like shadi ka laddu. Jisne khaya wo pachhtaya, jisne nahi khaya wo. So either you are in the markets and you're making some money, because if you are there is all this humbug that I'll buy at the bottom and sell at the top. Nobody can do that. Only the people who are staying invested are making money. The trading side of the market has picked up a lot of momentum. So you should be on either side. If you are following the market, if you are following us, we have been one of the few who has been positive. So like I said, don't miss the opportunity when you get declines, because this is a longer term bull market and it is here to stay. Because the sheer weight of liquidity Govindraj is something I've never seen in my lifetime. And I've been in this market for a fairly long time.
Right. So sheer weight of the bull market, the money flow that's coming in, or the easy money that's going to continue to flow is something that's going to keep things propped up. But otherwise, be very, very careful and don't be a Robinhood investor, because those guys are mostly out already. Okay. Thank you very much for joining us, Sanjiv, and hope to see you soon again.
Thank you, Govindraj. Wish you all the best.
Thank you.